All right, I would like to go over this problem one more time just to explain some of the intricacies of this. Now, as I said during class, this example problem from the textbook is a great way to review the 3 chapters. So in many ways, obviously go back and read chapters 1, 2, and 3, but if you really want to test yourself to see that you understand the material, these 7 or 8 pages, whatever they are a good way to review what you already know. Now, what they tell you here is that as of January 1, 2014, for $800,000 cash, Parrot buys all of the stock of Sun Corporation. So at that point, it's 100%. They own it. Now, at that point, Parrot would have debited the investment account, and likewise, they would have credited cash. They had that. Now, inherent in that transaction, Parrot is going to have to take that out that $800,000. They need to figure out the difference between the book value of the net assets they acquired and the fair market value of the net assets that they acquired. So in this case, there's $120,000 over and above book value that they can ascribe to, in this case, the 3 very specific assets. So of that $800,000 cash, they're paying for not only the book value, the original cost to Sun less its depreciation, but they're also paying for these at their fair market value, which again is sort of a rational decision made on the part of both parties. And what they tell you is that, well, part of this $120,000 difference can be explained by the fact that trademarks are slightly understated. So in fact, Parrot is going to recognize the trademarks not at $200,000, but implied at $220,000. Likewise, the patented technology is undervalued by $130,000. So buried within that $800,000 is the fact that Parrot is recognizing that the fair market value of the patents is $450,000. Now you also have this kind of strange situation here where the equipment could be overstated. So it's going to have to be written down, which is a little bit of an unusual situation, but with assets, a lot of things can happen. Now, you say, well, okay, gee, they paid $800,000, and the book value of the net assets they acquired is $720,000. They still have $80,000 that needs to be explained. Okay, well, the $80,000 difference between the two, ooh, how do you like my nice writing there? That is explained by goodwill. Anything over and above what they pay for the assets. If I again, taking the amount that they pay less the fair market value means that there's $80,000 that would be ascribed to goodwill. And in fact, you see kind of the analysis of this, that is, they're acquiring all of the equity of the company, the $600,000, and all the equity is another way of saying the net assets, that is assets minus liabilities. And that difference, the $200,000, will begin to peel off the layers that are going to be ascribed to specific assets. And again, what's left is the $80,000. And that's, in fact, goodwill. And goodwill is, in fact, implied in the $800,000 that they paid. Okay, now, this problem sort of combines a little bit both what's in Chapter 1 and Chapter 2, plus obviously what's in Chapter 3. Now, it wasn't specifically required with this problem, but to be sort of consistent with what they talk about in Chapter 2, immediately after consolidation. Now, with consolidation, as I said, Parrot would have debited the investment account, and they would have credited cash for $800,000, and that's it. That's all they would do. Now, if they had been required at that point, immediately after consolidation, or after the acquisition of that, to prepare consolidated financial statements, they would have made several adjustments. So to be clear with what would have happened, consistent with Chapter 2, what they would have done would be, first of all, one adjustment would be to debit common stock for $200,000, debit paid in capital for $20,000, credit the retained earnings for $380, and then credit the investment account for $600,000. So that wipes out part of the investment account of parent and likewise eliminates all of the equity of the subsidiary. Then the next entry would have been to credit the investment account for $200,000 and then debit the trademark for $20,000 and bring it up to its fair market value. Debit the patent for $130,000 and then credit the equity account for $30,000 because again you're writing it down, and then debit the goodwill account for $80,000. So those would have allowed you then to consolidate at the time of the acquisition. Now this problem doesn't ask you to do that. It kind of jumps in and says, okay, look, we made the acquisition. We know that you know how to make that consolidation at the point of acquisition. But we're going to look at this, what would happen 1 year later, like on December 31. Well, like we did in the first chapter, you need to figure out of those assets that were acquired, we're going to have to amortize them. Why? Because we want to bring them down so that on the part of Parrot's books, these assets have no value at that point, okay, consistent with Sun. Sun is depreciating their assets down. In the case of the technology, 10 more years, the equipment 5 more years. So remember, at the end of this time period, these things are being depreciated down to, let's assume the salvage value is 0. So at that point, Sun is going to have them on their books at 0 salvage value. And likewise, these amounts here need to be amortized down to 0 as well. Trademarks and goodwill, because they have an indefinite life, we're not going to do that. So taking up the amount that we're changing the fair market value by, dividing by the useful life, you get these two amounts which tend to offset each other, but the net amount is that the annual amortization that would be recognized would be $70,000. All right. All right. Now, throughout the year, Parrot Company would have made these entries to its investment account. In other words, at the beginning, like I said, they would have debited investment, credit cash for $800,000. Now, you can look at these as one entry, but they're doing it too. Typically, companies would declare a dividend, pay them several weeks later. So at the time of the declaration of the dividend, Parrot would recognize receivable, go ahead and debit the investment account. Then when they receive it, debit cash, credit dividends receivable. Now, December 31, at the end of the year, when both companies have completed all of the adjustments to their financial statements, they have actually, in fact, issued their financial statements. They're done. They're complete. So at that point, Sun has earned $100,000 of net income. And because Parrot owns 100% of the company, they're allowed under consolidation to bring that into, or under the equity method, in fact, really, to bring that into its investment account and recognize that as part of their actual earnings that actually will contribute towards net income. And that is increased net income by $100,000. But at the same time, they also, they call it equity and subsidiaries earnings, so they tend to be an offset. This is sort of a revenue account, if you will. This is an expense account, in fact. You use the same name for them, but they do net out. You'll see later on, they'll have the net amount of $93,000 as the amount that's really increasing the investment account. But the effect of all of these is to increase the investment account and to its ending balance, which is the 853. All right, now what you're asked to do here is to create a consolidated financial statement for basically, well, for Parrot. Parrot, because it owns 100% of Sun, it's the parent corporation, And really, it will be actually, its financial statements will be labeled as parent company, the consolidated financial statements of parent company. Sun is assumed into that, and the footnotes will disclose what these, a little bit more of the specific information. So the process is very similar to what you did in Chapter 2. It's a series of transactions, if you will, that will begin to peel off this investment account. Because again, the basic rule is that you can't have an investment in yourself. Remember, the consolidated financial statements are prepared from a worksheet. The consolidated entity really legally does not exist. But likewise, too, these items are going to have to be adjusted. That is, equipment, technology, trademarks are going to be adjusted to their fair market value. So we're going to go through and look at a series of adjustments that will make the financial statements consistent with that. Likewise, we're going to pick up, Sun will recognize the net income here, not directly, but it'll carry the revenues and expenses across, but the 100,000 and let's see whether here the dividends, okay, those are going to be removed from parent because again, parent is picking this up. It's in the investment account. The dividends are in there. So it's because these are intercompany transactions, they affect the investment account. We're going to have to remove the effect of that. All right. Technically, there is no specific order that you have to go through to make these consolidation or elimination entries. And basically, as I said before, what you're trying to do is to eliminate the effect of intercompany transactions. Generally, the first one you want to do is what the book refers to as Entry S, which is eliminating the subsidiary stockholders' equity accounts against the parent's investment account. So the first, and what you're doing here, you're always going to eliminate the beginning equity amounts, okay? And up here, the beginning retained earnings. Not, again, these amounts are going to change for Sun, okay, as it goes through subsequent years. So the first iteration is to go and eliminate basically what were the beginning equity accounts of Sun Corporation against the part of the investment account, which is the 600,000. Okay. Now, the second entry, kind of what we alluded to a little bit earlier, is to go through and recognize the fact that you have that when you purchase the assets, you really paid more, the $200,000 more. And that is the, again, we're kind of looking at the original 800,000, we're eliminating this. But part of that investment account is made up of these items here where we went through and we adjusted for the fair market value of the assets acquired. That is, trademarks needed to be written up. So the effect of this is to combine the two plus this adjustment to fair market value, which then gives you the 820. And do that for patented technology. One of the quirky little adjustments here, because we had to write down the equipment, 250 plus 220 minus 30 gives you the 446. The other adjustment that we need to make here, and it's okay on a spreadsheet, you can create accounts as you need it, is that they paid 80,000 over and above what was on, what we could specifically attribute to assets. So that constitutes goodwill. That goodwill exists only in the consolidated financial statements. There is no account under parent's existing ledger accounts where goodwill exists. It's only a spreadsheet invention. So that gets carried across here, and it will remain on there because goodwill is not amortized. Rather, it's going to be adjusted each year and appraised for its value. All right. Now, the next adjustment that you need to make here is by the end of the year, that parent took into its income the net amount of $93,000. That is, Sun earned $100,000, and Likewise, we have that amortization for the adjustment of the assets, which netted out to $93,000. So I want to eliminate that against my investment account. And at the same time, I also want to take that out of my financials, that is, out of the income statement of parent. Because otherwise what you're doing when you bring these amounts across here, which they do, is I would be double counting the income. So I eliminate the $93,000 from here. It's gone. It doesn't carry over. But the $93,000, the $100,000 of its income is right here, and those amounts flow over. Those are going to be recognized. The $7,000 amortization will be recognized as well, but it's not buried in the $93,000. So you need to eliminate against the investment account the $93,000 of income that was accrued to parent, and likewise eliminate that against parent's income statement accounts. All right, now the next elimination entry is that we need to eliminate the dividends that were paid by Sun Company. Now, part of this, and part of the confusion sometimes I have, is sort of getting my debits and credits straight. Where they have brackets around the numbers here, that constitutes a credit balance. And again, typically, retained earnings would have a credit balance, net income would have a credit balance, assuming that it's positive. But a dividends declared is going to go in as a debit balance into the financials of Sun because it is a subtraction from retained earnings. So that's why you need to make a credit entry here. And part of the confusion sometimes as I look at this is think, okay, wait a minute, all these things are supposed to have credit balances and you're adding another. No, in fact, this goes in as a debit balance. A dividends declared is subtracting from my equity. So partially it's a matter of keeping in mind the rules of debits and credits. And then likewise, okay, I want to, in fact, add the $40,000 back. Now, I'm not really, I'm sort of adjusting this against my total investment account. So the effect of the $40,000 and $93,000 is a net of $53,000, which is in fact what I ended up with. So when I take the sum of all these adjustments against the investment account, it ends up being a net $853,000 credit, which wipes out the investment account. Okay, last but not least, transaction E. These are the accounts where I made these calculations at the beginning of the year for E, and what E is just to allows me to recognize the amortization. Now again, these go in as an expense, okay? The depreciation is a credit because we had to write down the equipment, so it kind of goes in as a negative expense, which is an unusual situation. But again, I'm trying to take this to zero, like the other company, and then likewise kind of make the opposite entries down here to the assets. Patent technology, patents typically have, you make adjustments for amortization directly to the asset. They don't have anything here for depreciation, so we go ahead and make the entry directly against the asset account. Okay, so voila, those are the adjustments that you make there. That takes you to the end of the year of the first year for this company, making the adjustments, as I said. And as I said, these are, go back and take a look at these. The explanations are up here for that. And again, they do it in a very nice detail. Sometimes it's hard to see the two things as you're working together to try to understand what they're doing with that. But they do a nice job of explaining these as you go through here. But these, in a sense, you don't have to do it necessarily in this order, but this is the order in which the book typically will present it. And to a certain extent, it sort of perhaps makes more sense to do it this way. So at this point, we prepare the consolidated financial statements for parent, okay, because again, we're only reporting this under the parent's name at the end of 2014. It also recognizes, number one, what happened at the inception of in January 1, 2014. It recognized what happened throughout the year, and then likewise, subsequent to purchase, and how you go about making the consolidation after 1 year of operation. All right, Now, the last part of the problem here, the last couple of pages, what makes this a little bit more complicated, but it's sort of real life. The problem takes you through, number one, what happens at the time of acquisition for a parent company under the equity method, the entries they would make. And as I talked about at the very beginning, if they were to do a consolidation, what kind of adjusting entries would they make at that point to prepare consolidated? As I just demonstrated, and you see in the example here, what they would do at the end of 2014 to prepare consolidated financial statement for parent corporation. Now, finally, what they do is to say, okay, fine, you've got that down for the initial acquisition, the initial consolidation after 1 year of operation. Well, okay, what would you do if you had to go through all the way to 2017? What would you do to create the financial statements? They're not asking you to go back and do this every single year, but if I had the starting point, what happened at the beginning of 2014, all this information, how would I go about preparing consolidated financial statements for the end of 2017? And so I think what we'll do is kind of jump ahead here, because really the emphasis is really, I need to kind of play around with this number here. I know from what we calculated, they started with 800,000. That's what they paid. I also know from what they told me, and again, we're looking at this from, we'll do this in 2 stages. One is that from 2014, 15, and 16, 3 of the 4 years, the Sun earned these amounts of net income, 100, 140, 90. Likewise, they paid out dividends of 40, 50, and 20. Now, the amortization is going to be consistent each year, 700,000. So if you look at this, at the end of 2016, Sun Company, or excuse me, parent company, its investment account would have a total amount of $999,000. Okay, that would be the investment account. Then in 2017, that Sun Company earned 160, so parent will pick that up, less its dividends of 70, less the amortization. So you're going to have a net adjustment here plus 83,000. So 990 plus 83 gives you this ending balance of 1,082,000. That's the amount that they're going to be carrying in their investment account at the end of the year. At the beginning of the year, this would be the investment account, the 990. Okay, so from the beginning of the year to the end of the year, you have the $83,000 adjustment, and I can explain that by the income, dividends, and that annual amortization. All right, so we have the general information we need. Now, again, kind of taking in the basic order, that what parent wants to do is begin to peel off the amounts of from the investment account. Its investment account is right now the $1,820,000. So what parent wants to do is to peel off, number one, eliminate the beginning equity of Sun. From what they tell you here, it's right here, the beginning retained earnings of Sun was $600,000, and the total common stock and paid in excess has not changed. So the sum of those two would be this adjustment of $820,000. That's the first iteration, the first layer that we're going to peel off of the investment account. All right, now A is going to be a little different, okay? This is adjusting for or eliminating the adjustments that were made for the fair market value of the assets that were acquired. And first of all, and the important thing is, what you're going to be adjusting is the going back to what were the book values at the beginning of the year. Okay, so at the beginning of the year, since this is not changing, these two amounts right here, for goodwill and trademark, you're going to carry that at 20,000 and 80,000 until unless there's some evidence of impairment. But here's the tricky thing that you may have to do on separate sheet of paper, whatever, calculate what the book value would be. Originally, this was a $130,000 adjustment, but 3 years have elapsed, and each year they've been adjusting this downwards by $13,000. So after 3 years, there's been a total adjustment of $39,000 to take it down from $130,000 to $91,000. Likewise here with equipment, it likewise has been adjusted, but remember this is being adjusted in a sense upwards so that it will be netted out. The other adjustment we have here, find it here. Yeah, those are my 3 basic adjustments here. To eliminate, I'm not adjusting them, I'm not recognizing the amortization yet. What I want to do is eliminate against my investment account the A's, okay? The book values of the assets from the beginning of the year. Okay, just like we did in the previous example, one of the adjustments against the investment account is to eliminate the effect of what the parent recognized as its net earnings. So Sun had 160, but you have the $70,000 adjustment, so that nets out to 153,000. So that wipes out this amount because you can't show income from a company within yourself, and likewise it eliminates it against the investment account. So this really wipes out my investment account. Number one, I wiped it out against the beginning equity of Sun. I wiped it out against the 170.98 against the net book values of the assets that were acquired at the beginning of the year. And then two, the last adjustment here would be for the net earnings of the subsidiary for Sun. All right. Likewise, too, here's my D, okay, the dividend. I need to eliminate that for exactly the same reasons I talked about before, because these are credit entries. This is dividends declared. We need to wipe it out. And in a sense, it seems kind of odd to be adding it to the investment account. But in fact, when I take this plus these adjustments here, these 4 items will net out, debits and credits, net out to $1,082,000. So that's gone. Okay, the adjustment E is going to be the same every year, recognizing the amortization expense as sort of negative depreciation, and then recognize those as kind of offsets against the assets themselves. So basically every year until you get down to the end of the amortization period, you're going to make, E will be consistent. It'll be the same thing every year. So it's a little bit easier. Once you do it the first year, it's going to be the same thing every year. Okay, now the final thing that you have to do here is this adjustment P. And adjustment P is to recognize the fact that there is this intercompany receivable that in this case, it looks like the parent lent some money to Sun, okay? So on the part of parent, it has a liability that's you're going to debit that, and of course, making the credit entry against parent to eliminate its receivable, making the debit entry here against the Sun to eliminate the payable. So the intercompany transactions are eliminated. Okay, at that point, again, the impact of that is that these numbers carry across, and yeah, the $160,000 of income earned by Sun is recognized in the net amounts that get carried over here, not by the $153,000. Otherwise, you'd be double counting it. The amortization expenses are likewise recognized here, okay, by adding or subtracting. Those get carried over here. So in fact, really the $153,000 is recognized, but in the body of the income statement here. Retained earnings, again, you eliminate the subs retained earnings, carry over the parent's retained earnings, the net income only from the parent, and then likewise too, the dividends declared by the parent. Dividends declared by the sub are eliminated. The current assets, basically when you get onto the balance sheet, everything simply carries over. And if you did everything right, okay, which hopefully you did, the investment account is gone. The trademarks are now at their fair market value. And again, the the fair market value that you added at the beginning is being, that will stay the same. Patented technologies adjustment is being amortized downwards. Equipment is being amortized upwards. So the net amount of these is changing each year. These amounts really should not change except for any intercompany payables. So now you have this information here that allows you to prepare the consolidated financial statements.